Welcome to The Roofer Show with your host, Dave Sullivan. You found the podcast that helps roofing contractors grow their businesses, make more money, and have more free time.
Greg, what is going on, man? Thanks for coming on the show.
Thank you for having me, David.
Well, we hooked up through Dom Rubino, who's been on our show a number of times, also a great coach. And I know that you guys have been friends, so he contacted me. And just coincidentally, I've been really looking for somebody to talk about this topic because it is just so hot now with, mergers and acquisitions and private equity, roll-ups, all of this. And I've got a lot of our contractors that are getting phone calls left and right. It's all of a sudden everybody's really interested. And I think it's just amazing how, tells you how much money's out there. I'll tell you, looking for a place, it's just nuts, isn't it?
It is crazy. Like we were talking before the show is 10 years ago, there was not much activity. You had to turn over rocks to find someone willing to buy a home service or roofing company. And now you got to beat them away. It's like swatting flies. They're just all over the place. And you got to actually have a thoughtful plan and to evaluate all this stuff to see, should I keep running it and growing it, or should I take the money off the table now because the offer is too good?
There's a lot of questions about that. I went through the sale of my business, exited about 10, 12 years ago. And you're right. This is all obviously before all this money was out there so far. But
sorry to rub it in.
Yeah, my timing's always off, but hey, it worked out great. I'm doing what I want and life is good. So tell us a little about your background, how you got into this, and what's your story?
Sure. I am a recovering CPA. I started right out of college as a CPA, and I learned pretty quickly that I did not want to be a partner in an accounting firm. And I went into corporate and worked in the controllership, VP of finance type roles. And during my 15 years in corporate, I worked on 15 different transactions. But I left corporate because a lot of those companies were public-based or they were VC-backed, and they had very short-term views. And I grew up in a family business. My father was in the millwork distribution business, selling to lumber yards. And I was used to hey, what's the best value? How does this make sense for our family? How do we get the most money for our family over time, not at the end of the month because somebody wants to know how good you did this month? So I got disillusioned and I got tired of it and frustrated. So I went into succession and exit planning and coaching back in 2009. And I worked with family businesses and closely held business, how to transition. Over the years, a lot of the people initial thought was, hey, I want to give it to my kids. And as we were going through the process of getting the kids ready and getting the timelines ready, and it was always a mismatch. And sometimes the kids didn't even want it. They were doing it out of guilt. Sometimes they wanted it, but they didn't have the aptitude or the drive. Or if they did have the aptitude or drive, the timing of when the parents wanted to leave, when the kids needed to take over didn't match. So towards the end of 14, 15, 16, more and more of those families started coming to me saying, why don't we just sell it and give our kids money versus an asset to maintain? Because there's a lot of risk if they're not ready. Our retirement plans are contingent on this. Let's sell it. As we started to sell more, I got approached by a M&A firm to kind of merge my practice with them, and I started morphing my exit planning into M&A transactional work. And I had a specialty of a product or service called Catapult Connect. It wasn't called that at the other company, but it's Catapult Connect where the buyer and seller, and it's typically the private equity firm or a competitor knocking on your door saying, hey, I like what you're doing. I'm trying to grow. I can't grow organically. I want to grow through acquisition. And my clients are saying, I have no idea how to address this situation. Can you help me through that process? And that's where we are now.
All right. Well, it's interesting. I work with a lot of contractors and these family businesses, and you see a lot of this where there is no plan, and generally the dad or whatever, they don't really want to talk about it. It's just all kind of mishmash. You've got all these kids in there that nobody knows really what they're doing. It's just kind of a full employment, family program, and it's a mess. And, how is that going to work? And also, we talk about how this is something that takes a long time to really put together. So to put a plan together, don't you think you're looking at a good 5 years to get this company ready for sale?
Yeah, I think that's a really good time frame. Unless you've been running your business efficiently and with a strategic plan and updating it consistently. And There are some companies
If
that
they've been working with me, they have, but
if they've been
yeah,
working with you or they work with Dom or the industry, like and you know what's funny when someone is working with someone like you, it's evident, it's clear as day as soon as I start talking to them. When they're not, you can see there's a lot of different holes. They may have a great business, they may have a great brand name, but there are holes in it. They're doing one thing very well, but all the aspects of the business aren't really there yet. And that can hurt value. So if you want to make sure you can get the most for your business, you want to put together a plan where you address all the different issues that a buyer is going to see risk for, or a buyer may see an opportunity to leverage that to get more value. If you plan on fixing those things or building off of those, rather than saying fix, building those things into your ongoing business, you can really improve the valuation of your business and obviously improve your prospects for financial security afterwards.
we always say, build to sell, where we're from day one, we're building a business to sell it. Not that you need to sell it, but you have options, and this is the way you should run your business anyway. And by having a good plan and being able to work yourself out of a job, this is the biggest problem that I see is without that business, without you running that business is worthless, because you got a rake structure, management, everything comes through you. You can never get away. We start off with a program we call the 2-week vacation. And if you can't take 2 weeks off from your business, at the drop of a hat, you don't have a business, you've got a job. That business has no value. And the thing that people don't realize, they think their business is worth all this money. Well, I don't know, you would know the statistics, but I would say 90% of the businesses, they get to the end of the road, they think it's worth all this money, and they find out there is no value because you got a bunch of trucks and you don't have any systems and processes. The company's worthless and they end up closing the doors. Is
Yes.
that something that you see?
I do see it. Luckily, my clients are a little bit more upmarket and they've been
Yeah.
working to build it to sell. So, but I get calls all the time that are people that are maybe $1 million to $3 million of revenue, and they have like a couple 100,000 of sales discretionary earning, which basically is how much cash they take out of the business between profit and salary and perks. And hopefully they don't have too much perks. But the way you were talking about the 2-week vacation, as dead on when I meet clients, I love to meet them 3, 4, 5 years before they want to do that, so that they can actually maximize this value. And I give them tips and recommendations on how to go from A to B in valuation. But I use the term transferable business. This does not mean you have to build it to sell. You build it so it can be transferred. That could mean that you can build it so that your kids can seamlessly take it over. You can build it so that your management team has stepped up and they're willing to buy it out from you and take it over, or it could be a third-party sale. And this is probably more important. This is why I talk about the transferability. And it's really important now. Companies are knocking on your door. If you have a plan to how you want to run this business and where you might want to exit in the future, and then someone knocks on your door, if you understand what it's worth and you created a transferable business, you can actually evaluate these random offers and say, you know what, that offer accelerates my plan, I should take it. Or you could say, hey, that offer doesn't really give me any kind of shortcuts, I should just keep doing because I'm doing better than the offer. And you can do it with confidence without seller's remorse, or seller's remorse, whether you take the offer or you don't take the offer. You actually doing it with confidence because you know your facts and you know your business.
Well, let's talk about a couple of things. One is, why is this going on now all of a sudden? This is, I've been around the block for a while, and this is going way back. And when we had this whole series of roll-ups in the roofing industry, and you would get usually one business that ran this thing, put this whole deal together. They'd roll up all these companies thinking they're going to get economies of scale and so forth. And it just turned out to be a fiasco. And most of them all went out of business. Unfortunately, I was in talks with a number of these guys and just said, for me, it wasn't right. And I think that's something that people really have to understand, if it's right for them and what type of option, because it all sounds great. You think you're going to get a big bag of money and you're going to spend the rest of your life on the beach. Well, it doesn't necessarily work that way.
Not always.
There are other options. So let's start off. What's going on now? I mean, why is this happening now?
I think there's a couple of things going on. One is private equity firms have a ton of money to invest. It's a term called dry powder, which means they have money in their accounts that they need to invest, which in the way a private equity firm invests is buying private companies and rolling them up and then selling them to bigger companies or bigger funds. Right now, the last number I saw, and it's probably out of date by about 3 to 6 months, is $3 trillion of dry powder, $3 trillion of money that they need to invest. Now, these guys do not want to lose money. So they're looking for companies that are well run, less risky, and generating cash. So that's their general model. They need to find good companies to spend this money. If you're a good company that are at least at industry averages or better, you're seeing a lot of activity. Now, the reason it's coming into this home service market, and this is my opinion from what I've seen, other people may have slightly different opinions, but I think generally this is what's going on. When you're dealing with the home-based services, when you're dealing with the homeowner, there's all kinds of services where they're being underserved from industry to industry to industry. But there are these beacons out there that are doing great work. They're shining a light and making the industry look good. So there might be 5, 10, 15% of an industry looking great, that are doing a great job in building a reputation. There's a lot of other pretenders that are just using probably undocumented workers, or they're doing 1099 work, and when they really should be hiring them, they're not insured. But there's companies that are doing it right, and they're making a profit, and they're creating a good reputation. These are the companies that private equity firms are looking at. What I've seen was, what I saw was back about 10 years ago, the HVAC industry, they started doing a roll-up, and it was really on the residential side because they could get better margins selling to homeowners than if you were HVAC company selling to a GC, where they have to squeeze all the margins and all the subs so they could hit their project total. So the private equity firms look at these things like, okay, we have these individual people that have to have services. They need to have someone that's reliable. There's not many people that are reliable. Why don't we invest in those companies? Because they're getting great margins, great cash flows. And if we can get a bunch of like-minded companies, we can roll them up and then kind of create some synergy in the background. The other thing a lot of them were doing is they weren't doing, I think, the old model where one company was just bringing them all in and using the same brand name. They were doing it under a integration light model or a partner model. So there would be a platform company. We'll just pick my company name for an example, Catapult Roofing Services. But I would buy your company, and your company in your local market would keep its brand name and it would keep all the stuff. But we would take all the administrative stuff and try to streamline that, because that stuff's not really adding value. It's costing money, and you lose focus. And so that's what these companies have been doing, is letting the brand name stay in the market because that's where the reputation was, and just accumulating it. And when you go to the Catapult Roofing Services website, it says find a partner firm of ours or partner roofing company of ours. And then there would be all these companies that they would refer to come through their website. So they let people do the work that they were doing, and they didn't say, okay, we know better. They said, we can invest. We know this is a good investment. We've learned our lesson from the past days. You guys can run a roofing company or an HVAC company or a home security company better than I can. We just want to be able to streamline all the stuff where we can get synergies and scale.
HVAC, I mean, they've got reoccurring income on these service contracts too. I mean, gotta love
Correct.
that. Roofing's a little different unless you're in the commercial space. But yeah, that's what I'm seeing now. You're operating under your own business, where before you were rolled up into this one company, and Tecta is a good example. We're talking about there on the West Coast, and I was involved with that deal, long time. Really, the one that stands out as being successful and one of the largest businesses today, and those guys kick ass. So that's a good model, but I agree. The ones that I see now, you're just operating as you were, a lot of these. So let's talk about some of these options, because what we're talking about there is you're basically getting a bunch of money. You've got expertise perhaps that you're able to use, and you're just running your own business. You just continue to run it, but you've got these resources available to you. Others, here's a bag of money. See you later. We're going to take it over. We're going to bring in our managers, our professional management, whatever. And I think this is where you really have to understand how this works and what it is that you want to do, because it's all different. I mean, if you want to, you're young guys, perhaps, what are you going to do? You may have a lot of money, but now what? And you've always got to ask that question. I mean, most of these guys started a business, they grew it because they love doing it. And if you're just there's more than bags of money that you're doing this for. You're building
Right.
this company. So are you ready to walk away from that? Or are you working with a firm that wants you to continue to run it that way? Or what's going to happen? Tell us a little about the possibilities and how that's going to work, and some of the things that we should be thinking about if we want to really look at this.
Sure. I'll tell you, if you're willing to stay on, and usually the private equity firms now want the management team and the general managers, the key employees to stay on. Again, because they've learned their lesson. They don't know how to run roofing companies. They know how to make investments.
Right.
So if you're willing to stay on, which is what they want, your value of your company is worth more. If you have a key management team below you as well, where you can eventually step aside or be more strategic on, like, say, an advisory level, a board level with the platform versus the day-to-day, that actually increases your value as well. If there, like, I had a client, the second generation was the general manager, the first generation was at retirement age, the early 60s. And the way that one went is the parents said, we want to get out, but we have our son who's really been running for the last 2 or 3 years. And they said, well, and they came and interviewed him. Like, you're right, this guy's great. And they said, we're only doing this if we can make sure he's locked up for the next 3 to 5 years. And quite honestly, now he's in the Southeast. There's some smaller companies that they're looking at around him, and they're finding ways to take other, like, administrative stuff off his plate from his location, so he can tuck those small ones under him to have a regional powerhouse in his area. So they said, hey, these guys, and they were smaller roofing companies, big enough to make sense, but smaller than his. And they said they were older gentlemen and said, this makes sense if we take all their back office stuff and we just use those as satellite posts for like transfer stations to get materials, to crews to get their inventory, and to be able to market to different geographies. They're doing that. So they're leveraging their key GMs and the key employees that they acquire to help them grow organically as well as through acquisition. But if you're just looking for I call it the taillight Florida, because I'm from New England, that's where everyone goes. You're looking for that taillight check and sale, and then just go to Florida and you have to see them again. It's possible, but they're not, the private equity firms aren't as interested, and the valuations are going to be much smaller because that's a much riskier proposition for them. They're investors. They're to make a return on investment, and they want to make sure they get that.
And most of these companies, what do they have? You get a bunch of beat up old trucks, and what we're seeing is, and this is something that I talk about where, I'm on the West Coast and we have all W-2 employees. So we build a workforce, a solid trained workforce, where most of the country uses subcontractors. Well, where's the value in that? Because I don't need to buy a company to go hire a bunch of subs and go start ABC roofing down the street. So don't you think that having a good, strong workforce, which is so difficult to find right now, has a lot of value?
Absolutely. I'll tell you, if you're not managing your workforce correctly, you're not building a strong workforce, you're not building layers of management, you're killing the value. And there are some companies that can do the 1099 sub model okay, but you have to be very, very good and efficient, and you have to do it legally. You can't be breaking the rules, because I'll tell you, the first thing that every question we get when we talk about employees is like, do you have a W-2 or contractors? And if you have subs and 1099 employees, that just drags out, and they have to verify that you're complying with all the rules, what are the liability they're taking on. And in some cases, they said the liability is too big, we're not going to do it. If you're like trying to, like in the Texas and Florida, in Arizona, I mean, there's a lot more migrants coming across the border, and they're looking for work. If you're not doing the proper e-verify with the I-9s, that can have a dramatic impact on whether you can sell your business or not. It may seem like, hey, it's great, I'm getting these people to work for the bare minimum and we're making more profit. But when you go to sell it, it's killing your value, because they're going to say, well, we're not going to be breaking law. We're big enough. They're going to come and audit us. They're going to come after us. So it's going to cost us more to get in compliance. And so your true profit is not what you're getting. Your true profit is converting everyone to a W-2 and properly documented through the E-Verify system. So you should do that now, because if you're not, they're going to either cut your price or walk away.
I'm beating my head against the wall on this topic, because a lot of contractors, their sales guys are 1099 employees. That's the big one. Okay. Well, these guys report to you every morning. They take your orders and so forth. You are a freaking W-2 employee. I don't care
Mhm.
what you're doing. You can send them a 1099, whatever. That doesn't mean a thing. It do they pass the test? Most of these guys will not. They are employees. And the sooner you get your do it correctly, as you say, the better off you're going to be, because, and they have to understand. I've done 3 shows with my attorney about this, and nobody believes it. So I'm glad that you're validating this, because that is important, to have a workforce where you're not paying these guys cash and so forth. I mean,
Mhm.
you got to be running a legitimate business, and you got to be following the rules, as you say, because you're going to be looking at that type of thing.
Yes. Well, just when you're paying people with cash too, it's hard to verify what your true profits are.
Mhm.
Whether you're taking cash and put in your pocket, whether you're taking cash and then handing it to workers that are not properly documented. It's hard to really verify what your operations are, the cash flow your operations are generating, and that will kill the deal. I would say, do not as much as I hate paying taxes, I hate it, but I'd rather pay taxes and get my value. And I'll give you an example. People will hide. So let's just use the example. Last couple deals, the average deal multiple is around 6. Some companies that I've worked with get 7, 8, 9, but let's say it's 5 to 6, and we'll use 6 for this example. You hide $100,000 worth of cash, so that's, you save what, 25,000 to $33,000 in taxes. But by not being able to report that 100,000 as income, you
Right.
just lost $600,000 worth of value. So you gave up $600,000 in a check to save 25,000. Now let's make the numbers bigger. You're hiding $1 million, and I've seen people hide $1 million, and I had to walk
Oh,
away
yeah.
from these deals. Hiding $1 million in cash in perks. Like, I just said, there's no way this is going to get through diligence. Walked away, but $1 million. Okay, yeah. Now you're talking. Hey, I saved 250. I saved 330,000 taxes, and their CPAs are patting themselves on the back. Look how much I saved you. And then we go to sell, and like, hey, they go give your CPA a hug. He just cost you $6 million.
Yeah, it's crazy. I mean, these are the things that you got to understand. You got to plan accordingly. This is why it takes a long time to get this stuff straightened out. You got to be talking to
Mhm.
somebody that knows what they're doing. And there's so much money to be made in our industry doing it right, and just do it the right way. And that's a great example that you used there about hiding the cash and not having that as income on the back end, where you're going to get the multiple. It's, and I see it all the time too. So, well, that's a great point. I love that. Well, let's talk about first off, let's talk about the dark side of this, because, this is all not, it's just all not just, easy going and so forth. There's some, like any business, there's some shady characters in this business. What do we look for? How do we know if we're talking to somebody of quality like yourself?
They're willing to give you references. They're willing to let you talk to their clients. And even when you're talking to the companies that are buying you, like we do reverse diligence on those private equity firms. There's some private equity firms, they said, we're going to expect you to take, and we'll talk about this later on, I think, in the call. We're going to expect you to take a rollover, which means we're going to buy your company for $20 million. We'll give you $16 million of cash at closing, and we're going to give you $4 million of stock in this new company. And when we sell the company 3, 4, 5, 6 years down the road, you're going to get that 4 million plus whatever the return is. Well, now you're investing in this new company. Well, you need to know how they run their business and
Right.
how they treat their people, what promises they make. So we do a lot of reverse diligence. And if the private equity firm won't let us talk to their other portfolio companies and people that were rolled up into those portfolio companies and what promises were made to them and how those promises turn out, if they won't let us do that, or they won't give us references, then we say, hey, I'm not comfortable taking their offer because we don't know where they're going to stand behind what they said. They stand behind their promises. But most of them will. And the ones that are really successful, the really good and reputable private equity firms, and most of them are, will let you talk to them because they're proud of their reputation.
Sure.
They want to do that. And if they're not, then I get worried. And the thing is, if you're a professional private equity firm and like you're just building a fund and then selling off that fund and building a new fund and then another fund, you got to keep going back to get investors to give you money, and you got to keep finding investments to invest in. if you get a reputation of not delivering on your promises, either way, you're out of business. So the people that aren't willing to talk to you about, give you their references, they tend to be the ones that are try and make a quick buck because they see there's a ton of money in this space and we're going to bring a bunch of friends together, put some money together and see what we can do. But the ones who are doing it for the long haul and have a reputation long term and have multiple platforms, those guys are pretty reputable and they will very often let you talk to a lot of references and some of their past portfolio companies.
Yeah, and you can see, I mean, there's a number of firms that have, 5, 10, 15 quality roofing businesses that they've put together. So you can see them. You can talk to these guys. Hey, what's it like working with them? Because like a marriage, like a partnership, you're now partners with these guys, and
Yes.
you better know who your partner is, and you better like them because this is where things just really fall apart, and your life can be really miserable if you don't do it the right way.
For the most part, too, I'll tell you, private equity firms have a bad reputation. I think it's a lot of it too is you watch the movies and how like Wall Street and Gordon Gekko, and that's not private equity, but that's the image people have, or like Pretty Woman, Richard Gere, he was private equity. Those are people get a bad reputation because they see those how they try to buy companies and tear them apart. Most private equity firms aren't doing that. They are really solid citizens, but they are in it to make money. They're not in it to make you rich. They're in it to make themselves rich. Hopefully, if they're doing it right, and most of them do it right, both sides get a good benefit. The key is to make sure you just don't get blinded by the money and the quick exit, that you do your reverse due diligence because they're going to do diligence on you to make sure you're making the right investment, partnering with the right investor.
I did a show a while back. It's like why roofing contractors should be watching Shark Tank, for instance. Watch Shark Tank and you'll get a feel of what they're looking for. They are investing in your business. And the ones that get funded, well, first off, less than half of those that get funded on the show that get a deal, they don't go through down the road because of some, screw up. But they're going to, when what they're looking for is somebody that understands the numbers, and the guys that understand the numbers can rattle these things off that truly understand their business, get interest. Those that don't, they get booted out of there. I mean, that's the first thing. You got to understand your business. How much, what's your profit margins? What do you have? What's your competitive advantage? All of these things go into the valuation of your business. So on a small scale, I mean, it's easy to understand, it's entertaining, so forth, but I love watching that show.
But it's funny on a small scale. That's exactly what happens. Like you're going to ask lots of questions. They want to know that you understand it. Like one of the worst answers I've ever seen, and it comes up a lot, particularly the smaller companies. They go, "What are your margins?" Well, we'll have to talk to my CPA about that. I'm like, "Well, is your CPA every day running this business?" Like, well, how is your CPA pricing every single contract? Like, if you don't know your margins, how are you pricing? You're going to wait till you get your taxes done before you figure out if you priced it right all year long. So knowing your numbers is really important. Be able to say it and then actually show it to them. So there's two things: saying it and showing them. Because actually, when you go to sell your business, you're going to go through a process called due diligence because you're going to say a lot of things. And they say, "Hey, it's great. We love you, Dave. That's perfect. Now we trust you, but we're going to verify everything you told us to make sure it's right before you write this check." So that's a really key, is knowing your numbers, making sure that you're doing it correctly. You're not hiding things. You're not shifting things on. You run it to show a profit. I know it. And again, I know it's hard because you have to probably pay a little bit more in taxes, but I gave an example earlier. If you know you're in the process to build to an exit, you may have to pay a little bit of taxes, but a $25,000 tax payment could mean $600,000 of extra value. I think it's worth it. So I look at paying your taxes as an investment in the valuation of your company. So don't be afraid to show value. Get your books as close as you can to GAAP as possible. Like there's some exceptions based on size and the cost of having someone, but the closer you can get to generally accepted accounting principles, the easier it is to sell yourself to another company because they can trust your numbers. They know exactly how it will fit into theirs.
Right. I do a lot of business planning, actually fractional CFO work, and I see a lot of financial statements, and it's just can't understand what's going on, and you've got to have these things set up correctly. This is what we
Mhm.
always talk about. First thing we do is we go in and do a cleanup and get your chart of accounts straight and so forth, where you can see what's going on. And that's what they want. And really, what, 3 to 5 years, I always say, of good, consistent trends, because they want to see increasing sales. They want to see improving profits, I would say. Is that right?
100%. Trends have a huge impact on your valuation. I'm going to give you a quick example. Say there's three companies. One, they all have 20 million in revenue and 4 million in EBITDA, or bottom line earnings, cash flow. One went from 10 million to 15 million to 20 million. One was 20 million, 20 million, 20 million. One was 35 million, 27 million, 20 million. The one that was going from 35 million down to 20 million versus the one that went from 10 million to 20 million, two different, completely different valuations. It's $20 million company. The one that's growing is going to get 1 or 2x more valuation. The one that's coming down may not even be sellable because they don't believe they can stop it. The one that's flat will get a decent valuation, but it's not going to get a premium because it's just a okay company. It's not showing growth. And the private equity firm or the new company is going to say, well, we're going to have to invest to get it growth. It's a good company. It's a good base. It's a good foundation. But we have to pay them and then put more money into it to get it grow again. So the trends make a huge difference. And if you can start seeing where your trends are and then put action items into place and strategic action items into place to change the trends, that will have a big impact. And there's like what I call the holy trinity of valuation. There's lots of things I talk to clients about, but the three biggest things, if you work on these things, they cover about 80% of your valuation issues. Are you a growing company that's growing and generating a profit? You're not growing, you're not like giving it away to grow. You're growing your top line and your bottom line. You have a next tier of management. You have key employees that you can take you 2 weeks vacation. I always say, when I'm in New England, if I meet someone that's my first meeting is on a Zoom because they're in Florida and the company's running by itself up here in Boston, that's awesome. The company has people that they can run. There's people that work with the clients, the vendors, and the employees. That's not the owner. So you have a management team in place. And the third thing is you have processes in place where it's next man up. If someone quits, it's not like, okay, what are we going to do? How are we going to replace this? Where are we going to find it? How are we going to train them? Because David knew everything and now he's gone. Who's going to train David's replacement? You don't want to have your training process be Indian folklore from worker to worker. You want to have a process where it's one person leaves and the next person steps up, or ideally one person starts, they get promoted, next one comes in, promoted, step up. If you're in those three things, the holy trinity of valuation, your company is transferable to move at any time and it's worth more. And most likely it's easier to run and generating a lot of money for you along the way so that you have money in your bank, which makes it easier to be tough in negotiations when you don't need the money from the offer because you're saving it along the way because you're running it efficiently.
And you've got options. I mean, if you can step away and still have this company run without you, still generate great income, maybe you don't want to sell it. What's wrong with that? Let's just hang out and, you still got your company, you're building your legacy and you're still involved, get your fingers involved, because that's the thing, we on our,
Can I just interrupt for 1 second?
sure, please.
Those, I'll tell you, the way I get paid is I get paid when someone sells their company. That's where I make 95% of my money. But my best clients are the ones who don't need to sell because they're running the business and they're just waiting for the best offer. They come to me and I help them evaluate these offers and tell them, yes, this is a good one, or no, maybe, yeah, you probably should wait. My best clients are the ones who don't have to jump at every offer and aren't desperate to get out. So even though I get paid on a success fee when it closes, I make the most money on people who don't need to sell and run the business the way you just mentioned.
In our business planning, we've got a few things. One is we always start at the end. What is it that you're trying to do here? What are you trying to build? What's your destination? Then we can come back and build a roadmap to take us there. Then we've got the 2-week vacation because we have to build this out. I say it, it's like building a franchise, where you look at, just as you were talking about, you look at McDonald's, they've got standard operating procedures, SOP manuals that for everything, you're going to build a burger, boom, here's where the pickles go, here's where the ketchup goes. Everything is laid out. So as you say, you move out the next guy, bring in a new one. It's a repeatable system and a process. You've got to have that for everything in your business.
Mhm.
And the third big part of this, I think I called the view. And here you are, whatever you've done, and I've seen so many contractors do this, myself included. You get to the end, and here we are at the top of the mountaintop. I look out. How do you like the view? Do you like what you see? Well, I sold my business, but now I'm stuck at home. I don't have any hobbies. I don't really have any friends outside of the industry. And my wife's driving me nuts, and I'm driving her nuts. Is this how you imagine it? And that's why I like the idea of the view. Be sure you like the view. That
Yes.
once you're there, you've accomplished all these things. You've worked all your life. Is this what you really want? A lot of my friends, I'm older. A lot of my buddies are retiring and so forth. A lot of them go back to work. I'm back doing things.
Yeah.
It's what are you going to do? You better have that figured out. So it's just kind of funny how that works. And more and more guys are getting older and retiring and so forth, and all this is coming along. Okay, well, let's get into the crux, which is how much is my company worth, and how do I know, and how do we figure that out? And let's talk in about, say, $5-8 million business in sales, annual sales, and we're making money. Is that a good place to be for a potential target for private equity?
It's probably a little small for private equity. Private equity is looking at least $1 million of EBITDA. So let's assume you can get 20% bottom line. So
Let's explain what EBITDA is.
okay, EBITDA is I apologize for not doing that. All right. EBITDA is earnings before interest, tax, depreciation, and amortization. It's a proxy for free cash flow and how profitably a company is. It's not exactly free cash flow. It's not your profit. That's the basic standard measuring that you can go from apples to apples from company to company. So basically, it's saying, here's what my net income is, and we're going to get rid of interest because some companies bootstrap it, some companies finance it. You don't want to get penalized because the company that's using debt is going to show more expense than someone who bootstrapped it. But it doesn't mean your company's run worse. Your capital structure is different, but they want to eliminate that variance. Taxes. If you're a corporation, you get taxed at a corporation level. If you're an LLC or an S corp, you get taxed at the individual level. So we want to take out that tax piece so that the two companies, no matter what your legal formation is, or tax elections are, that your operations are apples to apples. And then depreciation and amortization we take out because two reasons. One is some companies are more capital intensive than others, and we want to make that playing field level. And the other is we want to know what the real cash generated each year is. So when you're doing depreciation, that's a paper number. You paid for it in capital earlier, and now it's just a paper adjustment to recognize it over a period of time. We take all those out to say, what is roughly the real cash generation of the business? So EBITDA is the benchmark that most private equity firms and most investors look at. There are exceptions, but I would say it's a high 90% are using EBITDA to do the valuations. $1 million is like EBITDA is a ticket to the game. So you need to have, if you're $5 million in at 20%, you're probably starting to get some looks, but you're not going to get huge looks because your top line's not big enough. But most companies that are at 5 million of revenue aren't getting the 20% EBITDA. They're more like 10 or 12, which is fine. But you need to get to that 15, 20, 25% EBITDA. And you do that by scaling because at a certain point, you don't need as much overhead to support the top line revenue. So if you need to get about $1 million of EBITDA, as you start to get closer to 5, that's when the valuations really start to change. So the companies that I was talking to that had really good valuations, they went from one went from about 8 million in revenue to around 25 million in revenue, and went from about 800,000 in EBITDA to about 5 million, 5.5 million in EBITDA. Another one 10 years ago was at about 2 million in revenue, grew to 25 million in revenue, had maybe 300,000 or so in they didn't even call it EBITDA, they call it sales discretionary earnings because it was just a job. They were taking money out of the business. Right. They grew it to a company that was generating about 4.5 million of EBITDA. Those are the companies that they're growing, and they have a more than $1 million, probably more than 2.5 million of EBITDA is really getting them high valuations. Once you hit 5 million, new ticket to the game. Once you hit 50 million, it's generational wealth. You probably never, your great grandkids probably never have to work again if you sell that company. I don't deal with those kinds. My clients are between 1 million and maybe 10, 15 million of EBITDA.
Okay. And, the problem that we see so often in this industry is just the focus on top line revenue. And they just don't make the profit that they should. They don't pay attention to the profitability. And you're just looking to grow that top line, but it is all about the profit, isn't it?
It is about the profit. Anyone can go, like I could go in, I don't know anything about roofing. I know how to sell a roofing company, but I don't know how to roof. I could go in and grow a roofing company because all I do is sell it at cost or sell it at a loss. I can win any bid if I want to underprice everybody, but you're not creating value. The private equity firms are looking for value creation. So they look for the companies that can sell it at a fair price, deliver it efficiently so they can generate cash flow. So you want to be able to have controlled growth. And I've seen a couple of companies that I've worked with that had to put a pause because they were focused too much on growth. And it's not like they were underpricing it, but it was costing so much money, and they had a lot of choke points that they were spending a lot of money on administration to get through those choke points that they weren't showing enough profit. Ultimately, when they got through that stuff, the underlying business and the way they were pricing it and delivering it was okay, but they had to get rid of all the noise that was holding them back because they grew too fast. Strong, controlled growth, and controlled growth is anywhere from 5% to 10% better than the industry. And the industry grows at different rates. Like I think the last couple of years I think the roofing industry on average is growing like 12, 13%. So if you can grow at 15 to 20%, you're killing it because you're growing with the industry and you're beating the industry averages. So now you become really attractive. Your valuations go up. So you're asking what the valuations were. If you're below $1 million,
let me just jump back on that because I think that's a real important point where controlled growth. Okay. That is really, I think, the key. And where, if I wanted to sell books and seminars and so forth, I would say, learn how to grow your business 20x. Okay. Well, that's a load of crap. I mean, that's not controlled growth. And when you're talking about the choke points, exactly right. Because to do what happens when you're growing too fast, you're not, you're out of control. And we see this a lot because the business is, the industry's been so hot. It's not rocket science to sell roofs, and so these guys are selling numbers. They're not charging enough money, but they're getting all this growth. Well, to do that, you don't have the people to do it. So you're throwing B and C players out there. Okay. You don't have the labor. You can't install the work profitably. And then we're throwing people also at the choke points, like you're talking about. Hey, it'd be great if we did this. I just need another person in the office. I need another person doing this. And the next thing you know, if maybe business slows down, I'll go into a business and all of these guys, I'm like, well, what the hell are all these guys doing? So when you look at the org chart, you've got all this overlapping stuff. It's just so inefficient that now your margins are suffering. So having controlled growth, it's a lot more fun. It's hell of a lot easier. It's a hell of a lot less risky. And this is what people want to see. It's not about, and I always love the, profits, top lines for vanity, profit sanity, cash flow is reality, and focus on that. Anyway, I'm sorry I cut you off, but that was an important point.
But that's 100% right. Like back in my corporate days, I worked for a company. We're trying to go public. We have a venture capital company, which is like a private equity firm, but they invest in companies that want to take public. So they're doing growth versus buying up established companies. And I remember I was talking to this guy. He was a young guy I'm going to say he was out of Harvard, but he was one of those big business schools. And he was showing how our company go from 180 million to like 350 million within 2 years. And I looked at the numbers and I'm like, I said, I'll say his name is David. I go, David. So I don't think you're being aggressive enough. And he goes, what do you mean? I'm like, well, if you change this percentage by another 10%, if you cut a person here, and if you do this here, I said, we could be $1 billion company in 4 years. He goes, you think so? And I go, on paper, I said, but we can't do what you just did. We don't have enough money to do what you said. We can't hire people fast enough to support what you just did. I'm like, I said, I can make any company a $1 billion company in 5 years by just changing percentages. You have to figure out, can you actually do the work, get the people, train them, put the infrastructure in place so that you can support it so it doesn't crumble under itself. So like you said, I think anyone who says they can promise 20x growth, yeah, maybe they can do it, but it's not going to be sustainable over a long period of time. Or you might not be the person that's going to reap the benefit. You're going to like burn out and someone's going to have to replace you to get to the next level.
We always talk about the three-legged stool. This is our business where those three legs, you have to keep that stool in balance and you got to keep it strong. And those are, you got to sell work, you've got to do work, and you've got to keep score. All three of those have to be equal and in balance. And what tends to happen is, okay, we got all the sales legs real strong, but the production, we don't have the people to do it. So our stool's weak. Or more likely is that the scorekeeping's all screwed up, the accounting, the bookkeeping. They can't, they're not getting their bills out. There's no job costing involved. They don't know where they're making their money, what's going on. It's just, oh, but I'm selling work. I'm getting it on. Look at this. I got to be making money, well, I don't have any money in the bank, but,
Yeah.
It's crazy. So you got to keep things in balance and have that controlled growth.
Yes. And you talked about like you're growing and you have these results, but you don't know why you're not making money. I actually worked with an HVAC company. It's probably 10 years ago now. And we're going through industry averages and industry metrics, and we're comparing their activity to the industry benchmarks and trying to find areas for improvement. And the industry average for margin was 35% gross margin. So revenue less direct labor and materials was 35%. These guys were at 30%. So we started investigating this, and I said, what are you pricing it at? And they were pricing at 40%. So they're pricing it at 5% more than the industry average, but they were getting results 5% less than the industry average. And so we started going through this. They had no idea why. And we had to dig through this. It was a science project because we didn't have the tools in place. And we had to go, once we figured out what the problems were, we built the tools to report on it regularly. But they were pricing everything at regular time. But a lot of the times people working overtime. They were pricing scheduled work at the same rate as on-call emergency work, where someone had to get out of bed and be on call, get paid for not doing anything until they got a call. They got paid. They were not pricing shrinkage correctly on the materials they were using independent contractors. The independent contractors would buy enough materials, and lo and behold, they were always buying about 10% too much so they could stock their other jobs. So they had a 10% shrinkage on material. So there was we found like 10 things that were going wrong. All of them very easily fixed, but until we identified where there was and how to measure and how to track it, they couldn't fix it because they were pricing appropriately, but they were delivering at 10% less than they priced, which made them less attractive because they were underperforming the industry. The only way to do that is to measure it and manage it.
Yep. Okay. Well, so I've got my $10 million business in sales, and I've had some good trends. Things are looking good. I've got my 10% EBITDA, and let's say we're spending off $1 million on this $10 million business. What's it worth?
Depends.
Exactly.
It depends on the trends. It depends on the team. Do you have a team? Like if it's Dave, it's just you and you're doing 10 million revenue, $1 million of profit. But if you go away and no one knows what to do, and that 10 million becomes 5 million, you're not worth much, if anything. If you're in Florida vacationing, or you're in California, so you might be going to Arizona or Palm Springs. You're on vacation while the business is running. Well, you might be worth a 5x or a 6x. So 5 or 6 million. If your company was
something that's important there, I think, is also when you talk about having your management team in place and so forth, you've also got to have them locked down. I mean, if they're going to, so often, hey, they're there because of me, let's say, the owner. When I'm gone, they're gone because, you're going to have some pencil neck in here running it perhaps. So you better have these guys on board and prepared to stay. And again, have your systems, processes, your positions laid out where if they do, you can plug in another guy.
Ideally, if the owner is in a strategic position and has made themselves redundant on the day-to-day operations and sales, that company is worth a lot. if the owner is the primary contact for anything, whether it's the sales process or the operations, production, administration, if you're the primary contact for anything where something has to go through you, you hurt value. What I see is there's companies that are in that less than 10 million is they're afraid to let go. They can't manage unless they do it. The way to get value is you have to train other people to do what you do, to have them replicate. Use the phrase before, I love it, I think it's 100% correct. The franchise model. You're not selling, don't have to be McDonald's, but you need to set the franchise like people, no matter who you hire, you know what they're going to do because you have your way of doing it, and we know your way works, and you're just going to keep replicating it. So when we want to grow, if we need another project manager to oversee 2 more or 3 more teams, we already have the roadmap. We just take that roadmap and hire the person, train them, and you go. We have your hiring process, like how do we find new teams? Well, we have our roadmap of how we recruit and hire them, how we pay them. Well, if you already have that roadmap, once you see that your marketing is turned on, like, okay, we can replicate that hiring process and training process. Having that franchise model and having other people that have the primary contacts with the customers, the relationships, and the vendors and the employees makes you eminently more valuable. So I love that franchise model. That's the key to doing it is being able to have yourself step up. The less important you are to the operations, the more valuable your company is. And this is hard because most people that I've worked with, they've done a great job building it to a certain point. But then at a certain point, they just can't let someone else do it. And those are the people that kind of get frustrated, like, why is my business worth more? I'm killing myself. And the people who say, you know what, I want to grow and I want to get bigger. And the only way to do that is to get other people to act like me and do what I do. And that's creating that franchise model. Those are the companies that are very valuable. And by the way, you can spend your time in Arizona or Florida, or wherever you want to vacation, because you have that team in place, you have that franchise model.
I love it. Okay, so we've got this $10 million business. We've done some things right. We talk about multiples now. Bottom line, what's my business worth, and what does that mean to me? This, we talk about second bite, let's talk about multiples first.
So multiples first, depending on where you are, from if you're below $1 million versus $1 million to 5 million, 5 million plus, the multiples can vary. Like if you're below $1 million, you might be looking at a 3 or 4 multiple, 3 to 4 times what your earnings are. If you're at $1 million to 5 million, depending on all those factors we talked about, it could be anywhere from like 4 to 6 million. And the difference is 4 to 6. Do you have the franchise model in place? Do you have growth? Do you have all this other stuff in place? If you have all the other stuff in place, you might be at the 6. And then as you get above the 5 million, you're probably looking at the 5, 7, 8. Maybe if you get someone really interested or a competitive situation, you could get a little more. But that's kind of how I've seen the market moving. Those aren't guarantees. Those are just rough ranges. And when your specific data and your specific trends in your specific market will plot where you are in those ranges.
So I got my $10 million business, spinning off $1 million, basically running a good business. And let's say that's, I'm going to get a multiple of 5. That's $5 million for your business. I mean, the valuation.
Potentially, yeah.
Correct. Okay. Yeah. So that's really what we're looking at, where, I work with, $1 million, in sales, hardly making any money. They think their business is worth $3 million, It's crazy. So I love the way that, your explanation of all this, particularly these smaller companies, really have no value, right? I mean, unless you can find somebody that's willing to buy it. And this is also why I like if you've got something unique, where something of value, and we talk about things, what has value, that workforce has value, because there's a lot of companies that will buy your business for that trained, awesome workforce.
Yes.
Also, what we did, we had really focused on growing our service department, maintenance contracts, reoccurring income, high margin stuff, repeatable. So that has additional value, strategic value. Do you have something different that maybe a larger company wants to get into metal roofing, for instance, something like that? Agreed? If
you have a niche that you do something better than everybody else, that a bigger company can take and scale, that adds more value. That changes the dynamics. Like, that's why when someone says, what's my business worth? Well, if you're just a vanilla company on the industry averages, going to be somewhere in there. But if you have all the infrastructure in place and you have a niche that someone with deeper pockets can exploit and leverage and bring across the country, that has a huge impact. I'll give you an example. I worked with a HVAC company, and they had an engineering component. And it was HVAC distribution with engineering. A lot of the distribution companies couldn't figure out how to offer engineering to their services. This company was in New England, figured out how to do it. And there was this big company down in the Tennessee area, I believe, and there was a private equity firm backing them. And they said, we want to do that. We love this engineering model because you're getting a premium. Like what they would do is they weren't charging for engineering. They were just saying, if you want engineering services, they got an extra 10% on the product. And they said, but we can't figure out how to do it. So they bought the company to then have that owner teach all the other portfolio companies how to add the engineering component. So the company, when we did the valuation just on paper, what it was worth, it's probably worth $5 or $6 million. It was like 7 years ago, so I'm off on numbers, but 5 or 6. They got like 8 or 9. So they got like almost a 50 to 100% premium because they had this niche that the big company said, if you could teach all of our other companies to do that, we'll pay you a lot more than your company's worth because it's worth it to us. And so he got it.
Hey, riches are in the niches, man. I love it. So, well, Greg, I could talk to you all day long. I love this stuff, but you're obviously just a true pro and have so much experience in this. If our listeners, if this is something they want to look at, they kind of fall into these categories, they're doing some things right, what should they do to get in touch with you?
The easiest way is I actually just launched my own firm, Catapult Advisor Group. And my domain name is catapultadvisorgroup.com. So right up there on that screen.
Advisor or advisory? I see advisory.
Advisory with a W, with a Y, excuse me. Easy for me to say. Catapultadvisorygroup.com. There's a contact page. Just type in your name, your phone number, and just a quick little message saying I heard you on Dave's podcast and I have some questions. I market through education. Most of my clients aren't ready to be sold within the next 3 to 5 years, but I want to make sure as many of these businesses are on track to get the results they want, not hoping they get the results they want. And I figure if I can help enough people out and add enough value before I actually start working with them, they'll call me back when it's time to actually engage with me to do that work.
That's awesome. It does take a long time. I mean, you got to start preparing, and that's why we start early before you're ready to do this and get your business ready to sell. And then get in touch with Greg and talk about it, and it all works out, man. That's awesome. So, hey, well, Greg, thanks so much. I really appreciate you coming on the show and having this conversation. I got to reach out and thank Dom for hooking us up, but that's awesome. So let's keep in touch.
Great. Thanks, Dave.
Thank you.